Right now, as you're watching this, almost $4 billion has already vanished from Bitcoin ETFs in November alone. And BlackRock's flagship Bitcoin ETF just saw $523 million walk out the door in a single day. Most people look at those headlines and instantly assume the worst. Bitcoin is collapsing. Crypto winter is back, that it's over. But that surface level story is exactly what they want you to believe. Because when money moves in billions, and moves fast, it is never just about price weakness. There is always something deeper, a trigger, a pressure point, a hidden catalyst. And if you track what's been happening since October 1st, you'll start connecting dots Wall Street hopes you never connect. Because this story isn't really about crypto at all. November 2025 is now officially the worst month in history for Bitcoin ETF outflows. We're talking about $379 billion pulled, breaking the previous record set back in February, when Trump shocked markets with surprise tariffs. BlackRock's Bitcoin fund, the biggest Bitcoin ETF on the planet, has averaged more than $2 billion this month alone. Fidelity, Grayscale, every major issuer is watching billions evaporate. On November 21st, nearly $1 billion exited in just 24 hours, the second largest single-day outflow ever recorded. Retail sees this and immediately screams, Bitcoin is dying, crypto winter has returned. But that's the illusion, because while retail dumps bags and financial media writes obituaries, something very different is happening behind the scenes. And it starts with a government shutdown almost nobody paid attention to. October 2025, the United States government shuts down. Not for a few days, for 43 days, the longest shutdown in American history. And when the government shuts down, the Bureau of Labor Statistics stops releasing economic data. No jobs reports. No inflation numbers. No retail sales data. The White House even admitted some October data may never be released at all. Think about that for a second. The Federal Reserve is trying to make interest rate decisions while flying completely blind. And during that exact blackout period, Bitcoin fell from $126,000 to below $82,000, a drop of over 40%. That correlation is not random dot, it's a straight line. When market makers lose visibility, they don't wait around and gamble. They pull liquidity, cut exposure, reduce positions, and sit on the sidelines. The Congressional Budget Office estimated this shutdown would shave up to 2 percentage points from fourth quarter GDP, which is massive. And yet almost nobody is talking about how this liquidity became targeted risk assets, like Bitcoin first. And here's where the story becomes something completely different. Because while billions have been flowing out of ETFs, smart money has been aggressively buying. Look at the on-chain data. Wallets holding more than 10,000 Bitcoin, the whales, the institutions, their accumulation score is heating up fast. They're not selling, they're loading up. Abu Dhabi Investment Council, a sovereign wealth fund, tripled its Bitcoin position during Q3 to $520 million. MicroStrategy, led by Michael Saylor, keeps buying every dip aggressively. Morgan is accumulating Bitcoin exposure quietly. These aren't retail hobby traders. These are the people who move global capital flows. And they know something retail forgets every cycle. ETF outflows don't mean Bitcoin is dying. They mean ownership is changing hands. When regular investors buy Bitcoin through an ETF, they're tourists. They come when prices pump. They leave at the first sign of trouble. They panic. What we're watching right now is weak hands being shaken out. ETF redemptions are just retail capitulating after months of chaos, volatility, and fear. They bought at the top, and they're selling at the bottom, again. Meanwhile, institutions are moving Bitcoin off exchange sand into cold storage. Long-term holder wallets now control over $200 billion in Bitcoin. The realized cap for addresses holding more than 155 days just crossed $56 billion. These are the strong hands, the conviction money, the players who win every cycle. Because this exact pattern appears before every major bull run. Distribution gives panic, gives accumulation, gives breakout. Retail gives institutional weak hands, gives strong hands. 2020, before Bitcoin ran from $10,000 to $69,000. 2016, before the run from $650 to $20,000. Same pattern, same psychology, same outcome. Meanwhile, the Federal Reserve is trapped. Inflation is still elevated. The economy is weakening. They need to cut rates to support growth, but they fear reigniting inflation. And now, because of the shutdown data blackout, they're making decisions in darkness. The CME Fed Watch now shows only a 48.9% chance of a December rate cut, down from almost 90% just weeks earlier. Uncertainty kills confidence, and when confidence evaporates, risk assets, especially Bitcoin, will get crushed first. Some analysts warn Bitcoin could test $76.0 or possibly lower before this cycle washes out the last sellers. But here's where things flip again. Right now, the crypto fear and greed index is sitting at 16. Extreme fear. Lower than during COVID. Lower than during the FTX collapse. That is capitulation territory. And historically, when fear maxes out, the next leg up begins. Look at what's happening across crypto. While Bitcoin ETFs bleed, the new XRP and Solana ETFs are seeing massive inflows. XRP, $410 million, Solana, $300 million. Money isn't leaving crypto. It's rotating. It's repositioning for what comes next. Bitcoin dominance is rising towards levels that historically mark major cycle tops. And those tops usually appear just before massive altcoin seasons. So the investors pulling money out of Bitcoin ETFs right now aren't leaving crypto. They're being impatient. And that impatience is creating the opportunity. So what do you actually do with this information? Because information without action is just entertainment. First, understand that ETF outflows are lagging indicators. By the time you see billions leaving, institutions have already positioned themselves. They're using derivatives, OTC desks, and off-exchange accumulation, invisible to the public. Second, Bitcoin has entered a compression phase. Volatility is down to 21%, extremely low for crypto. Historically, that precedes explosive moves. Third, watch the catalysts. The government is reopened. Economic data returns in early December, and the Fed rate decision is approaching. If the Fed cuts and data shows weakness, Bitcoin could rally sharply as a hedge against currency debasement. Fourth, stop trying to time the exact bottom. No one ever has. The strategy that has built more wealth than any other is simple. Position when fear is extreme. DCA through panic. Here's the truth. The Bitcoin ETF outflows are real. The pain is real. But the story behind the story is about a massive wealth transfer. From people who react emotionally to people who understand cycles. From weak hands to strong hands. From retailers to institutions. What you're watching right now is the setup for the next major Bitcoin rally. Whether it happens in weeks or months, no one knows. But the pieces are already moving into place. The shutdown created the excuse. The fear created the opportunity. And smart money is accumulating while everyone else is looking the wrong way. So the question is, are you following the crowd out the door? Or are you recognizing the pattern? Because the people who win in this market aren't the ones calling tops and bottoms. They're the ones who understand when fear has gone too far. The next 60 days will separate people who read headlines from the people who read patterns. Which one are you? If this changed the way you're seeing the market right now, hit subscribe. Because what happens behind closed doors over the next 60 days will determine winners and losers for the next 5 years. Don't miss it. I'll see you in the next video.